Good morning and welcome to our clients and guests. Thank you for joining us for this morning's budget. As you've seen, we've adjusted the agenda slightly, so we will be unpacking the 2022 budget, as well as providing you with some insight in the latest developments between Russia and Ukraine. My name is Kim Watson. I am a Business Development Manager at RMB Forex. Our speakers today is Mamelo Matsinkinya Ingwenya, FNB's Chief Economist, Jan Bester, Sanctions Manager at First Rand Group, and John Cairns, Client Strategist at RMB. So the budget was widely expected to be good, with the increased tax revenue due to stronger commodity prices. But what is key is how the Finance Minister intends to spend the additional revenue. Mamelo, good morning. Could you give us some context in terms of what was delivered in the Finance Minister's budget for 2022?
Thanks, Kim, but I see that Neil is on, so perhaps we should maybe hand over the mic to him and I will answer your question after him.
Perfect. Sorry about that, guys. Neil, good morning. We've got an additional speaker joining us this morning, Neil Shearing. He's a chief economist at Capital Economics in London. It's been reported that Russian military vehicles have entered Ukraine. Neil, if you could please give us some insight in terms of what's happening with those developments and the impact that it's going to have on financial markets.
Yeah, good morning, everyone. Thank you for inviting me. Yeah, I mean, clearly so I hope everyone can hear me. I see some messages that the sound's not good, but yeah, if you can't hear me, say. I think clearly it's the case that the situation on the ground is still very uncertain and unclear. It looks as though what's happened overnight is that Russian troops and Russian forces have struck outside of the Donbass region and are now hitting targets outside in other major Ukrainian capitals, including some air bases, military air bases, and some air bases outside Kiev too. And it looks increasingly like those cities are kind of on a war footing, and civilians there are. And there's been air raid sirens and civilians are moving to bomb shelters. So it looks like the assumption that I think most people, including ourselves, had going into this, which was that this was a conflict that was likely to be isolated and contained within the Donbass region and might dissipate relatively quickly. I think that assumption has been blown to pieces, frankly. I think this is a major escalation, and I think it calls into question the extent to which we really can expect this to be confined to that region. I think this is now a major escalation of the conflict. We're seeing that reflected this morning in financial markets. So futures in Europe down 3%. Oil prices back above 100, so up to 102 on Brent. 10-year treasuries trading at 1.9% now. So rallying bonds, sell off in stocks, rallying in oil. To give you a rough sense of the kind of economic hit from this, clearly the costs and the hit will be hardest in Ukraine and Russia itself. Ukraine is going to need a massive financing program and support from the IMF and EU to avert a balance of payments crisis in the coming weeks and months. The hit to Russia's economy from relatively modest conflict and modest sanctions would be about 1% in our estimates. But if things really escalate and it looks like they're going that way, and we've got much more severe sanctions, then including potentially removing Russia from the SWIFT payment system, then that hit could be up to 5%. In terms of other countries, the main channel comes through commodity prices. We've done some work looking at how far commodity prices have tended to rise when we've had conflict and stress and strife in commodity producing regions. The answer to that is that relative to current baselines, we think that oil prices could go to the $120 to $140 a barrel range. That would add about 2 percentage points to inflation in advanced economies. So it would make the inflation challenge in advanced economies even greater. There's then a question about how central banks respond to that, whether or not they have to accelerate tightening or they look through that increase because of a squeeze on real incomes and the headwind to growth. And we think probably the latter at this stage. They probably wouldn't adjust their tightening plans. And that's reflected in what's happening in markets. So the futures curve has taken out 1 hike in the US, so now expecting 6 hikes rather than 7 this year. In terms of markets, previous conflicts, we've seen equity markets fall by about 20% peak to trough, and then rebound relatively quickly. We've obviously had a fall in the S&P already. We think most of that fall is down 12% year to date. Most of that's about the Fed rather than what's happening in Russia and Ukraine. So there's potentially quite a lot of downside still to come in equities. Possibly, if things really escalate, we think the S&P could fall to 3,600, something like that. So there's quite a. I'm talking there about a severe escalation and conflict and substantial sanctions and a response by the West and then the counter response by Russia. So that gives you a kind of sense, I hope, of the kind of worst case economic hit. The hit on inflation and the feed through to financial markets.
Neil, thank you so much. We appreciate you coming on so short notice. I know that you have to leave. So we're going to pass it on now to Jan Bester. The US, European Union and other Western allies have announced limited sanctions, and they could target more of Russia's biggest banks, cutting them off from the global financial system. Jan, what implication will that have to our South African business clients if they're exposed to Russia as a region?
Kim, thanks for the opportunity. Yeah, as you know, there are existing sanctions in place against Russia, emanating from the Crimea incident a couple of years ago. The US has followed a similar route by they've issued Executive Order 14024, as well as a directive linked to the executive order. And they're focusing on this, allowing investment in the two regions. And we can expect that the same will follow as soon as Donbass has also declared their independence from the Ukraine. Focus on access to capital markets within the US and by US persons. And in the Directive 1, they specifically mention the trade in ruble and non-ruble bonds, especially the secondary markets with relate to the bonds by US persons. So, you know, South Africa is not being touched directly yet, but I mean, if you trade in a US bond, probably US dollars will affect or they will flow through the US. The European Union has followed a similar route, also restricting access to debt and capital markets. The UK has followed a different route. They have sanctioned 3 individuals directly, as well as 5 banks. And they've imposed asset freezes on the 8 parties that has been sanctioned at this point. So once you deal with any of those banks and this UK connection, you will definitely be impacted. Apart from the 3 major sanctions restrictions, sanctions regulators, Australia and Japan has also imposed sanctions, but that's primarily against individuals and entities that was involved in creating the independence of the 2 regions at this point in time. So from a South African customer perspective, there's not much influence at this point in time, but be very careful because the situation is extremely volatile and things can change within minutes. Depending on the action from Russia, and then the counteraction from any of the major regulators across the globe. United Nations has not imposed any sanctions, and they will not. They can technically, they can, but you know, as you know, Russia is one of the 5 permanent members of the Security Council, and they have a veto right, so they will never impose sanctions on themselves. So UN at this point in time is out of the picture. Thank you.
Yeah, and thank you for that. And with sanctions being a tool to deter further aggression, like you said, there probably will be further development on that front. We'll just ensure that our research team keep our clients up to date on the implications for that. Okay, Mamelo, over to you.
Thanks. Thanks, Kim, and good morning to all the participants on the call this morning. So I think, yeah, yesterday was a fairly big and busy day on the SA front. The Minister, Enoch Gonongwane, delivered his maiden budget speech. And our assessment of that is that the speech was, I think, cautiously indicating government's commitment to continued fiscal gradual consolidation. I think this provides needed policy space, certainty and sustainability. We maintain our view that the extent to which government is able to achieve fiscal sustainability will be dependent on implementation of expenditure restraint and accelerated growth enhancing reforms. So I think while sticking to the fiscal consolidation path, and we do note that implementation risk here is quite high, the budget recognized the need to support the ongoing fragile economic recovery. So we certainly view it as being positive for households. So in the budget yesterday, we saw that income relief of about 5.2 billion to consumers was extended. And this was from adjusting income brackets in line with inflation and by not increasing the fuel and road accident fund levies. We think this is critical for supporting the ongoing fragile economic recovery and should counteract the negative impact of several headwinds, ranging from higher energy and food prices to, of course, a relatively less accommodative interest rate environment. I think ultimately, the continued slack in the labour market poses some downside risk to consumption expenditure. And I think in this regard, Treasury has increased, the employment tax incentive. We saw that by 50% to about 1,500. And this is effective March this year. So I think this, together with the President's request, to companies to reduce the experience requirements when hiring young people, should somewhat help to curb, the stubbornly elevated youth unemployment rate. Another positive that we saw yesterday was that Treasury, proceeded with implementing the corporate income tax rate reduction to 27%. We definitely think that such a policy position, together with the promising growth enhancing reforms aimed at reducing the cost of doing business and improving efficiencies, should ultimately boost private sector fixed investment and to some extent employment growth. And of course, there's always concern around, the wage bill. And we saw yesterday that, compensation of employees budget has been lifted over the MTIF. It is expected to drop towards the later part of the expenditure framework, between 2022, 23 and 23, 24. However, the terminal point is still higher than the previous projections. So this is ultimately showing that wage pressures will likely continue to mount. And on average, the wage bill is expected to grow by 1.8%. So we think that the risk is that the unplanned spending, was around 20.5 billion higher than what was projected in the budget and close to what has been accommodated over the entire MTIF. So, while Treasury has made allowance for the extension of non-pensionable cash gratuity, it states that the above inflation salary adjustments will necessitate headcount reduction. So we obviously are going to keep a close eye on that and see whether they are able to meet those stated targets. So I think just on the macro side, so if we look at Treasury's growth projections, and this is where we have a bit of reservation, and we think there could potentially be some upside risk. Treasury slightly trimmed its 2021 growth estimate to about 4.8%. This essentially aligns with our long-term standing forecast of 4.7% for the year 2021. This adjustment reflects the worse than expected impact of the July social unrest and the cyber attack that we saw on Transnet. But over the medium term, Treasury's growth prognosis settles at an average of around 1.8%. And ultimately, this is not enough to create much needed employment. So this is where we see some risk. It was also not adequate to widen permanent sources of revenue base needed to provide the social safety net to the most vulnerable people. So although they put that target down for the current financial year, it's not clear if they do plan to sustain it, how that's going to be financed. So we saw yesterday that there was no big decision being made on the basic income grant yet. The low economic growth poses risk to fiscal sustainability, and the pressure for larger social spending support could mount. And we think that Treasury's medium-term growth projections are understandably built on conservative assumptions about the pace of economic growth. And we concur with Treasury that there is risk to the growth projections emanating from potentially, new COVID-19 variants, persistent electricity supply interruptions, rising inflation and borrowing costs, and I think a faster than expected tightening of global financial conditions. Treasury believes that the reforms are critical to economic and employment growth, and in this regard, it's prioritizing 55 projects. So this is, I guess, consistent with what the President mentioned in the State of the Nation address, and I think quite pleasing to see that Treasury and the Presidency are sort of speaking from the same hymn sheet. So they continue to prioritize infrastructure project, and they're quite determined to implement reforms that are aimed at stimulating demand through these employment programs, tax incentives, social transfers that could boost consumption and easing the skills constraint, and of course increase productive capacity. So I think on inflation, the Treasury's forecast is benign relative to ours by an average of around 0.2 percentage points. The average is around 4.8% this year, and they see inflation stabilizing at around 4.4%, and 4.5% in the year 2023 and 2024. Respectively. We are, of course, concerned about the higher oil price. We do think that poses some upside risk to our near-term inflation outlook. So I think on balance, Kim, the budget delivered yesterday was positive, and I think the market at large received it in a positive manner. We are, of course, worried about the projections that they've made over the medium-term expenditure framework. More specifically, if you look at the targets that they've put forward in terms of the revenue that they expect to collect, and also if we look at the targets that they have in terms of lowering the debt to GDP ratio, we think that's going to be quite a high hurdle that they would have to get over to achieve those goals. But I would say, near term, we would give the budget, I think, a relatively high score, but definitely worried about the outer years. I'll leave it there. Thank you.
Mamela, thank you. Great insights as always. John, if I could ask you to come in here, please, and just tell us how this will impact the financial markets. What are we seeing this morning? And it's a bit of a difficult picture with what's happening in Russia. But if you can just maybe give us an overview of everything that's playing out.
Morning, Kim, and morning, everyone. Thank you. So two big events for our markets is obviously the budget and then the whole Ukraine issue, as we've discussed. The way to think about it is the budget is more important from a longer term South African perspective. I think Mamela set out the issues there about a good budget in the short term, but longer term questions about fiscal sustainability. But short term issues, it's all for the financial markets, are going to be dominated by the Russia and the Ukraine situation. Just before I get across to those short term implications, just one additional element to add to what Mamela said. Now, our analysts in the RMB markets research team have been chatting extensively to foreign investors, and the tone from foreign investors has been incredibly positive towards South Africa. South Africa has been viewed as a darling of emerging markets recently. The reasons for that is expectations of a good budget, which has now been delivered, rising commodity prices, and a relatively stable political situation. Of course, we do have the ANC elective conference in December, which a lot of our international clients are asking us about. But South Africa has stood out in emerging markets as an attractive destination. Perhaps the easiest way to express that is just that South Africa is not Brazil with its political troubles, Turkey with its currency problems, or Russia and Ukraine. So we've actually seen a good foreign inflows, really liking the fiscal story that Mamelo set out. The budget was largely in line with expectations that we've been expressing to foreign institutional investors. Short term, however, it's definitely going to be the Russia and Ukraine situation that dominates. Now, the first thing that Neil set out when he spoke is he said that he envisages what has happened now as a major escalation. From the early market news this morning, it wasn't clear exactly what has happened. Is Russia just moving into the areas that are held by the separatist breakaways in Ukraine, so in the eastern Donbass province, or is this now a movement into the whole Donbass region, so not just one part of it, but the entire, or two provinces in that region, or is it a full-scale invasion of Ukraine? So Neil, who's very experienced in these issues with his team, clearly from his comments believes it's now a fuller escalation into a full Ukraine war situation, so probably a takeover of the full Ukraine. Now this will impact us in South Africa through three channels. So the first is risk aversion, and we've already seen that play out most obviously in the Rand this morning. So dollar Rand between 5 and 6 a.m. jumped up to 15.25 from the 15 level, and we've got up to a high of 15.37. So risk aversion is the immediate short-term impact. It's just sentiment. Dollar Rand is tracking with other risk assets. I was also put a lot of emphasis on what Neil said about the S&P. The S&P is now about 14% off its January highs, about 5-6% actually off from its highs yesterday. So we're definitely having a huge impact on US equities. And in many ways, US equities sets the risk tone. So arguably the movement in the Rand is not quite matching the weakness in US equities. So just a worry there that we could have more risk or feeding into the Rand. Okay, the second channel of influence into South Africa or into the global economy is going to be via commodity prices. This is a silver lining for South Africa, but before I get to that, just the negative consequences. So Russia and Ukraine are major exporters of oil, gas, and soft, so wheat and maize. So presumably, well, we have to wait and see. We can ask Jan the sanctions that are going to be imposed on Russia and Ukraine. At this stage, the US officials have suggested that they are not going to limit oil and gas exports from Russia. That's a big statement. If you're not sanctioning oil and gas exports, what are you actually sanctioning apart from individuals and banks? The real pain, if you want to really inflict the pain on the Russian economy, you have to go after the energy sector. So we sit there not knowing quite sure whether Europe, US will impose sanctions, even though the US has indicated so far that it won't on the energy sector. Now, what we're definitely seeing is a sharp jump in the oil price. On my screen at the moment, just traded to 103 on Brent, we're back at 102. Neil was suggesting 120 on oil. So further substantial upside in energy. Okay, South Africa is an energy import. We're already going to see our petrol prior to this incident. We're already likely to see our petrol price going to 21 Rand per litre, and a significant jump in the wholesale diesel price to over 20 Rand a litre. So pump price moving towards 22 there as well. You add on this move, so the upside in terms of our domestic petrol price is going to be even higher. So commodities, we have oil and grain feeding through into global inflation and then local inflation as well. The silver lining, though, is that some of our major export commodities stand to gain from what is happening in Russia and Ukraine. So the first one is gold. Gold is your haven against risk. Gold has rallied. The market's now talking $2,000 an ounce there. On this, as an aside, it's interesting to note that Bitcoin and other cryptos have fallen on this news. So this story that crypto is a safe haven against global geopolitical risk is not playing out. Gold is assuming its normal safe haven status along with the US dollar, treasuries, Japanese yen, and Swiss franc. So gold has gained on risk aversion. Our second largest export at the moment is the platinum group metals. South Africa and Russia are the dominant players. Zimbabwe, Canada are additional but much smaller players. Russia is particularly big in palladium, as a palladium producer. Now, I haven't seen particular research on this, perhaps Jan knows, but there is scope that Russian platinum group metals, the PGM exports, could be sanctioned. If that is the case, then we're going to see significant upside in platinum and particularly palladium price, and therefore another positive adjustment in terms of how our trade dynamics are playing out. The third market, commodity market, that could be, well, probably will be impacted will be coal. So we saw during the European energy crisis in the middle of last year, middle and late last year, that the coal price did extremely well. So when there is a shortage of gas, high gas prices, and sorry, by the way, European gas prices have jumped 40% this morning alone. So higher gas prices, shortage of gas, higher oil prices, and naturally producers are going to switch to coal as a source of energy production. So we have potentially probably further upside in our coal, the Richards Bay export price. So 3 of our 4 major exports, gold, PGMs, and coal, could all do very well in this environment. Our 4th, iron ore, probably more affected by the economic consequences than anything direct. Russia, Ukraine are not huge players in that market. Where I'm going with the second thing, so the first point was risk off. The second channel influencing us is via commodity prices, is on a direct basis. This is actually good for South Africa in that our commodity export prices are probably likely will surge even further. And they've been doing very well this year, and this is just going to take them further. So we are potentially going back to the commodity export environment where we were in June, July last year. And just to note, the dollar rand got to 13.40 in that environment where we are running trade surpluses of 50 to 60 billion. Okay, so get out of the immediate risk aversion. There are positives, call it a silver lining for the rand and for South Africa via commodity prices. The third channel that we need to think about is how central banks, including the Reserve Bank, are going to react to this. So Neil already sketched out the views from Capital Economics. He noted that they're going to take 1 hike off from what the Fed is expected to do. This is similar to the views I've been seeing from other international houses. In other words, while this incident is inflationary, it's also a hit to the economics, to the real economy of Europe and US. And on a net basis, central banks are going to react dovishly to that. Dovishly in the sense that we're going to get less rate hikes than we had originally assumed. We'll have to wait and see how it plays out in South Africa. Yes, there will be inflationary consequences, particularly from the oil move. But to some extent, South Africa is insulated from an inflationary perspective relative to, particularly to Europe. Okay. Most obviously, one, we don't use natural gas in a significant way in South Africa, either directly or indirectly in electricity production. So while Europe and to some extent the US are going to have a surge in energy costs, we are somewhat shielded. obviously we still get the petrol price, the diesel price impact that I spoke about. The second way that we are partially protected in terms of inflation is that while the coal price, as I mentioned, is likely to head substantially higher, Eskom purchases coal on a long-term contract basis, and so rising global coal prices won't mean that Eskom has to jack up prices even more. Obviously, they're jacking up prices as it is, but at least they don't have to go up even further than what they've asked for. So yes, we will get an inflation feed through into South Africa. Arguably, well, I'll have to check in with our research team, but this could be temporarily pushing our inflation above the upper end of the 3 to 6 band. So remember, inflation got to 5.9%, we've dropped back to 5.8%. We have been looking for it to go back to 5.9%, the forecast from the research team. Maybe this just pushes us above the 6%, but that will only be temporarily. Core inflation in South Africa still remains constrained, 3.5%. So as the energy and food prices work their way out of the system, inflation will come off. So net inflation will be higher, but we not expect our research team to change their view to expect a sustained long-term breach of the inflation targeting band. Nevertheless, as an emerging market, we have to spend more focus on inflation and less on the growth aspects. So whereas the Fed and the ECB, as Neil argued and others have argued, can be more dovish as a result, the Reserve Bank is probably going to have to be a little bit more hawkish in terms of their thinking. So Kim, the bottom line here from South Africa is risk off. We haven't necessarily seen the end of that. Okay, so if this is indeed a full invasion of Russia, then dollar rand could rise even further. We did an internal survey earlier this month. Where would dollar rand go in a full invasion scenario? The talk there was dollar rand would jump about 50 cents. At that stage, dollar rand was 15.20. So our trader salespeople were arguing 15.70. 50 cents from 15 takes us to 15.50. So 15.50 to 15.70 range seems a reasonable estimate if this is indeed a full invasion. So that's the knee-jerk reaction. Second impact is longer-term positive trade effects. Short-term, it's going to be risk aversion that will dominate the rand movements. Longer-term, the commodity prices come into play. Marginal upside pressure on our interest rate environment. And then to circle back to the beginning, we had a good budget. That's good for South Africa. Foreign investors have been liking what they see about South Africa. A further positive shock to our terms of trade in terms of positive commodity exports prices is going to encourage that trade after this period of risk aversion. So substantial short-term negative skim, but we do have to, but on the positive side, longer-term positives both from commodities and the budget. And I'll hand back to you, Kim. Thank you.
John, thank you so much. Very detailed explanation. So thank you for that. We don't have any questions at this time, so I just want to hand over to Mamela one last time. Is there any last comments that you'd like to make?
I think maybe, thanks, Kim. So I think a point that was also just made in our engagement this morning, which is important to note, and I think a very valuable observation from one of our colleagues is that if one looks at the work that has been done by SARS, so they've done quite a lot in terms of trying to improve efficiencies at SARS. They've hired a number of individuals over the past financial year, and they are really leaning quite heavily on AI and technology to try and help improve efficiencies with revenue collection. So I think that is quite important if we look at the potential upside risks to the budget, which is, I think, it's important just to try and balance those. You know, so we speak about the longer term. We are concerned about the government's ability or National Treasury's ability to meet its targets. I think that tax story is quite important when one looks at the potential upside risks. And secondly, as I said, the growth projections that National Treasury have put forward are quite low, especially in the context of what the minister said yesterday around, South Africa cannot afford to grow below 2%. So by their own projections, they expect economic growth to be below 2%. And if indeed they're successful with implementing some of the reforms, I mean, like the near-term reforms could, around energy and allowing for self-generation, part privatization of the ports and railway. We saw over the weekend, for instance, Transnet being quite vocal about, welcoming private participation in terms of improving our rail system, which is quite critical. So I think if they do get those things right over the short term, and of course, I mean, another one that was mentioned in the SONA is around the auctioning of spectrum, which the president said, they're giving themselves 100 days to try and implement some of these reforms. So if indeed they are successful, we could potentially see some upside risk to the medium-term growth forecast. So I think, it's quite important to balance the risks out. And I think lastly, Kim, the minister yesterday also just spoke a little bit around, small, medium enterprises and a guarantee scheme that would enable small businesses that historically wouldn't have had access to bank credit to be able to participate a little bit more. And this really speaks to this need to incentivize small businesses to create employment. So as I said at the beginning, it's quite nice to see that, the presidency and the National Treasury are speaking from the same hymn sheet. So what would be quite critical, and I think a lot of people always criticize the government and National Treasury, is around implementation. So how do we implement some of these things to ensure that these concerns as analysts that we have about sort of the medium to long term downside risks are mitigated?
Mamelo, thanks so much for adding those additional comments. We do have some questions coming through. The theme does seem to be about how to manage the various types of exposure depending on what's happening in which market. I'm going to start off with John, how have interest rate markets reacted and what does this mean for rate hedging?
Yeah, thanks, Kim. So our domestic interest rate markets have actually risen. So the longer term rates have risen mainly on the budget, well, initially increased on the budget and then early this morning again on the Russia. And looking at our short dated FRA instruments, they're also higher. In other words, the market is pricing in additional rate hikes here in South Africa. This is actually nothing new. The market has been pricing significant SWAB rate hikes for a while now. In our view, the extent of the rate hikes is overdone. Nevertheless, because we are in a rate hiking cycle, we're getting a lot of corporates, companies coming to us to speak about interest rate hedging. We're having to be quite innovative in this environment because, again, the typical vanilla instruments are, in our view, quite expensive. So our clever structurers have come up with innovative ways to hedge interest rates to protect your business against rising interest rates. Please reach out to us, Kim. I guess that's the bottom line. We'll have to go through that on an individual basis with companies, but definitely we can help you. If you have got floating interest rate debt, please speak to your RMB FNB representative and we'll bring our experts out to chat to you. Thanks, Kim.
Thanks, John. The next one I think both yourself and Jan could tackle for us, please, is how do clients handle direct purchases from Russia in dollar, South African clients at the moment?
Yeah, I'll let Jan deal with that, please, Jan.
Yeah, direct purchases from Russia or even exports to Russia. I mean, there's a huge component of fruit exports down in the Cape region. Not affected at this point in time because the banks that is being used are not some of the sanctioned banks. But if and that's I think that's the ultimate sanction against the Russian economy. would be to cut the Russian financial systems out of the SWIFT gateway. Now, that will mean that there's no money flowing either in or out of Russia through the formal banking sector globally. But that's a very harsh measure. So at this point in time, we still have the gateway to export and import goods involving Russia, except for there are a number of restricted goods that are not allowed, and that primarily relates to the energy, the oil, the gas sector, the banking, obviously, debt and access to debt and capital markets, engineering environment, and then defense and related materials. Are at this point in time already prohibited to a large extent. And then potash. Potash is also restricted. There's a lot of restrictions. So the quantities, the routes, the destinations and so on are restricted to a large extent. And coming back to the platinum, the PGM possibility, that's a very distinct possibility that especially the US might use that, might add that to the already restricted goods being imported from Russia. So if they put restrictions on any imports of the PGM group, you know, I'm not sure how that's going to impact us, but following on to John's discussion, it might benefit South Africa because now it opens the market for our platinum exports to a larger extent. But like I said, you know, sanctions is very fluid at this point in time. We can only monitor on a minute-by-minute basis. John, to the question whether Russia has actually invaded the Ukraine, I see New York Times reported that they have entered through the Crimea region, in other words, affecting Odessa, one of the big harbors in the Black Sea. So things are happening. Things are most definitely happening. Yep.
Yeah, and thank you so much. One last question, John, if you could take this one, please. Could you maybe touch on fuel hedging for the upside risks to the oil price?
Yeah, thanks, Kim. Yes, we can hedge fuel. We can hedge different grades of fuel. So petrol, diesel is the most common one used in South Africa. We can do machine fuel, bunker fuel, all type of fuels. The fuel price in South Africa essentially has two components. The first component is the global refined price times by the exchange rate. So that's primarily just the oil price, refining margins, and then the dollar rand. Now that part we can hedge completely. The second part of the fuel price is taxes and so on. Mamelo mentioned that the Minister of Finance kindly gave us some reprieve in not increasing that fuel levy. Essentially what we do here in RMB is we hedge that first part. So it's the oil price, the refining margin, and dollar rand. This accounts for about 95% of the movement in our domestic fuel prices. Of course, we just can't hedge that under the tax changes. Various instruments are available there. We can use swaps, so that's equivalent of just an FEC in the foreign exchange market. We can do collars and other instruments. The one important distinction here in terms of understanding fuel hedging, many of us are used to dollar rand and the positive forward points on dollar rand. The oil market trades differently. The forward fuel price does not necessarily have to be the current fuel price plus interest rate differentials. The future fuel price is traded completely separately and often, and for the moment, has been below the spot price of fuel. So by hedging, you're actually locking in a lower rate than is currently in play. Of course, that is offset by the positive forward points in dollar rand. Of course, we're hedging it from a rand perspective. Kim, just in terms of hedging fuel, look, the oil price has been on a one-way trend from $20 per barrel to $100 per barrel. I keep hesitating about fuel hedging because are we now entering the market at a high point? I mean, that's the worst thing you want to do, is go and lock yourself in when prices are already high. But if you listen to Neil, $120, he's talking about now on oil. Perhaps there is still a possibility. And again, if we go back to the collar instruments, at least will protect the fuel price movements on the top side and at least provide some offset if fuel prices come down. Kim, last comment from me is it's a very interesting phenomenon. Because the future oil price tends to trade below the spot fuel price, actually, historically, when we do the back testing, we've actually found that people who buy their fuel forward, so hedge it, actually outperform people who buy a spot. Okay, so there's arguably an arbitrage there. Historically, you've saved money by buying your fuel forward because of that, what we call the technical term of backwardation in the fuel market. Again, please reach out to your RMB F&B rep, and we can bring the fuel experts to discuss and explain this, how this works. Thanks, Kim. Back to you.
John, thank you so much. Thank you to all our speakers this morning for your time and for your valuable insights. We really do appreciate it. And thank you to our clients and our guests. I hope that this was insightful and helpful. And if you do need any additional information, please feel free to get in touch with your F&B or RMB representative. I hope you have a good day further. Thank you.